The best real estate investors aren't using traditional mortgages anymore, and they don't want you to know what they are using. There's a category of loans, such as DSCR, that let investors build portfolios without the red tape of personal income qualifications. If you're trying to scale your real estate portfolio using W-2 backed loans and income documentation, you're walking when others are sprinting and losing deals in the process. I'm Andrew Russell, owner and founder of RCG Mortgage, three-peat winner of Broker of the Year, top originator across the country, and I specialize in working with investors on securing the right mortgage products and acquiring real estate riches. One of my greatest clients and most appreciative client that we've had in the last, several years is actually an investor. It's an investor that I met at a networking event and, just kind of mingling, doing my thing, dancing a little bit to Bad Bunny. I actually, stumbled into this investor, introduced myself, asked what he did. He said he bought properties. He had some kind of connections with realtors. He bought properties typically under market. He bought them very quick, and then he buys and he holds, meaning that he rents them out. So I said, oh, that's so cool. There's so many mortgage products now that exist. Who do you use? Who's the mortgage company? I own a mortgage company. I'm pretty good, I heard. And he said he would get private money or hard money first. And then after a year, typically around a year's time, he would refinance out of the hard money loan or the private money loan into a 30-year fixed rate mortgage once the property had been rented for a year. Now, if you don't know about a private money or hard money loan, typically it's a 1-year loan. It's interest only. It's around usually 10 or 12% for the year. They collect that 10 or 12% up front. So say it's $1 million loan. It's a lot of money that they are in fact collecting up front, for a year's worth of payments, right? On top of that, there's closing costs. Typically hard money or private money loans. And again, just like a DSCR, it's a no income check, but the closing costs are very high. The title fees are typically high. Sometimes the attorney fees are very high. There's points. What does that mean? Whatever loan size you're borrowing, there's a lot of money you pay off of that loan size, whether it's an origination fee to whoever's originating the loan, maybe monies to kind of buy down the rate. Just a lot of closing costs, way more than you typically pay. It's typically the most expensive of all the mortgage types. And the rate, again, market rate. If the market rate right now is in the 6s, getting a rate in the 12s, obviously super high. It's allowed because it's an investment property, but it's super high. So I said, I don't understand. Why do you do that? He said, well, it's not rented. You have to buy it and get whatever mortgage will allow you to buy when it's not rented. Refinance it once there's enough, a year's gone by with an actual person that's renting it. So I said, I don't understand. What am I missing here? He seemed like a really smart guy. Why don't you do a DSCR mortgage? He's like, what's a DSCR mortgage? And I was like, cha-ching, a DSCR mortgage, a debt service coverage ratio mortgage. You don't have to have a property that you're purchasing. They go off market rent. You don't have to have it actually being rented. So his mind is like, and I do that with my kids. So his mind was actually blown. You can buy a property. He could have been buying all these properties. He's 1 to 4 families, a lot in Brooklyn, some in Queens, a lot of 2 to 4 families, to be honest. He was buying a lot of them with 20 or more % down, which is a great down payment number. And the market rent would have covered, but they're typically vacant. So as long as, and we kind of talked through a couple of them, it would have been a home run for him, but just because he's getting them at such a low price, they all would have qualified with the rent. So we talked through a couple of different scenarios, and it turns out that pretty much all of them would have qualified for DSCR. And what does that do? Number one, still gives you the flexibility of 20% down, but this time at a 30-year fixed rate mortgage, not a 12% rate, something in the 6s or 7s. It's a clean 30-year fix. Where, part two is you don't have to refi again. Now in New York, closing costs are wildly expensive. Typically there's mortgage tax, there's a lot of closing fees, escrow accounts. Sometimes the origination is a little bit higher. So what this gave him was the opportunity to eliminate one specific financing type, replace it with the better option. And he was able to, on future transactions, he didn't have any then, but it turns out every 2-3 months, this gentleman would reach out, have another great property, and there was no cap on the amount of mortgages that he can get. But he would reach out, we would price him up, and we still, as we speak, last week he had a scenario that we priced up for him, 20% down, just on the market rent, no more hard money, no more private money, into a great interest rate at reduced fees comparatively to a private money loan. Literally, we saved this guy probably in future equity in the closing costs, $20,000 to $30,000 in future lost equity every single transaction. And you do the math, $1 million at 12%. It's, quite a bit of money every month. We save him thousands and thousands of dollars a month just by putting him in the right mortgage. And of course, there's always the haterade when I give all this good news. Hey, Andrew, you always make it seem so easy. Nothing in life is this easy. No, it actually is. Sometimes you're just going to the wrong place, or you just aren't educated at what's out there. Before DSCR mortgage existed, maybe this made sense. Maybe, years ago, probably 5, 6, 7, 8 years ago, you would buy with a private money or a hard money loan. You'd refi into a normal loan once it was rented, and you could show a history and use that to watch the mortgage payment. But now with the new DSCR, go to all investment mortgages, this is something that's very simple. So I'm not oversimplifying this. It's just as simple as when you buy a property, as long as, and we'll talk about this, we'll go into the qualifications, as long as your credit's there, from a profile perspective, as long as you have enough money for the down payment and the market rent is there or close to covering the mortgage, you qualify all day long. And of course, instantly I've already killed the haterade of, hey, Andrew, the rate must be so much higher. I just showed you how the rate is so much lower. But these programs, the interest rate is very in line with whatever the current market rate is. There is something we'll talk about in a little bit. Prepayment penalties, 0, 1, 2, 3, 4, or 5 years. The more or higher the prepayment penalty is, the lower the interest rate. Why would you ever do a prepayment penalty? We'll talk about that. But typically these rates right now in this specific market on DSCR are smoking hot. And of course, hey, Andrew, this is where the crash came. This is an exotic mortgage, no income check. Clearly, we're going to, revisit what happened, a little over a decade ago. No, it's not the case. Typical DSCR clients are putting down 20 or 25%. So the equity position on investment properties is so much higher. On an aside, I would love if investment purchases allowed 5% down. But right now, the investment DSCR side of the world, with the down payment being so high and the credit profiles being so good, it doesn't allow for mortgage lates and a lot of the crazy stuff. So your credit profile outside of just the score has to be exceptional. And they want to see a lot of money left over in the bank after you close. With all those qualifications as requirements, the crash just not going to happen again. All right, so I think the best thing for us to do right now is we're going to show you that what this investor was doing on the private money or hard money side, which isn't something that we typically offer at scale. Super high rates. For whatever reason, I feel like it just makes my firm just look very bad. I'm going to show you what he was used to and accustomed to, and then where the closing costs were, so where the savings were. But then, of course, I'm going to show you the DSCR mortgage, why it's so powerful, why all investors consider this the GOAT of all investment mortgages. But first, make sure you go in the description, click the link. We have the DSCR, the GOAT of all mortgages, all investment mortgages. We have an easy cheat sheet, an easy guide. Make sure you click it, save it. It's for you. It's free. My team spent a lot of time making this for you guys, so make sure you go in the description, click the link, and get the free guide to the GOAT of all investment mortgages, the DSCR mortgage. There's no catch. We're not going to blow up your phone with annoying texts that are going to be green and not blue, right? You've been there. But make sure, description, link, click it, DSCR, GOAT of all investment mortgages. It's just for you. All right, so if we're going to talk about this investment gentleman, so let's talk about, just in general, $1 million mortgage for argument's sake. So typical investors have private money or hard money companies that they work with. Why would they ever want to do that? Because they get financing fast. Typically in 2 to 3 weeks, they can get financing. They don't ask for pretty much anything except for the corp docs of what they're buying under. It's quick, it's easy, investors love that. But if you look at the math logistics, it is ugly, folks. It's like watching the Jets on opening game, which I was there, gets smoked out by Rodgers. It's ugly, guys. So 12% interest only is, these are typically 1-year loans, interest only. So let's do private money over here. So 12% is $120,000, and that's over 1 year. So that's what you pay as a mortgage payment and interest over a year. So if you divide that by 12, you're paying $10,000 a month for a payment. So if you're borrowing $1 million, what they do is, they're pretty smart, these private money guys. They add that on top. So now over here, you're borrowing, let's put it down here. You're borrowing 1,120. Because what they do is they front the first year of payments, and when you pay off the loan, they give you a refund of the rest. But assuming this guy was holding on to it for a full year, he was paying $10,000 a month, which is ludicrous. Now, on top of that, outside of the normal closing costs, typical attorney fees in these type of transactions, typical attorney fee, which we'll talk about on the DSCR side, $12.95, maybe $14.95. I've seen them over here, attorney fees $49.95. So, you're talking $1 million loan. I mean, a couple $1,000s either there shouldn't be a big deal. It's just a lot of money. It's a lot of wasted equity in the future. It's a lot of money in closing costs. And there's typically up to 4 points on these. So what's a point? 4 point could be a lender cost, a broker cost, but 4% of this is $40,000 in points. So if you do the math, you have 40,000, you have another potential, difference over there, 4,000. There's payments through the roof. It's a ripoff. Andrew, why would anyone ever do this? Again, number one, they didn't know that you can actually finance these when the property is actually vacant. But number two, it's just quick, it's easy. People have relationships. Maybe they get this 10 or 12% a year down to 10%, maybe 8%, but this is what it looked like. So just to show you and put this in perspective, the $1 million over here, if we did a DSCR mortgage, so if this was, as an example, a 4-unit property, so down here we'll say a 4-unit, which means there's rent from unit 1, 2, 3, 4. And this is how we're going to qualify it, right? So $1 million loan, let's use a rate of about 7%. Let's use a 7.5% APR. So over here, if you have a $7,000 mortgage payment, principal and interest, the difference, now we'll show you tax and insurance, right? On this, I think it was about $12,500 a month in taxes and probably another $300 for insurance. Now I'm only showing you this so you can see the DSCR and how that works. Now, apples to apples, you're talking about a difference in $3,000, which is ludicrous. So $8,250, $8,550 is actually the full mortgage payment. You actually on the private money loans, you pay the tax insurance actually yourself outside of the transaction. So the difference was right away $3,000 a month. So if you times that by 12, that's $36,000 in 1 year of savings. If you just apples to apples and didn't get this mortgage, plus the difference of that 40, typical DSCR loans have about 1%, give or take, in fees. That saves 30, right? So that 36, now you're getting another 30. On top of that, you have like another, let's say, 5,000 in closing costs. So it's like a $70,000 swing right away. And to boot, to make it even crazier, this mortgage was being refinanced into a loan similar to this. So there's title fees, there's attorney fees, you're paying all that again. So it's probably another $20,000 in wasted costs. So just by going on the right loan initially, they were able to save almost $90,000. Now, let's talk about the DSCR mortgage specifically and why this mortgage made so much sense. So all right, now on the DSCR side, the typical purchase scenario the gentleman was doing, again, $1.25 million 4-unit or 4-family. Now, what is a 4-unit or 4-family? That just means that there are 4 rentable spaces legal within it. You've seen it like where you walk in and maybe there's 2 floors, 2 on each floor, or it's just 1 on the floor and goes up 4 stories. But this is a 4-unit property in Brooklyn. 20% down, so you're talking about $250 down. So that's going to net out to, like we said, remember, $1 million loan. Just to re-put our stuff, 7.5% APR, very loose on the payment. Should be around $7,000 just for the principal and interest. $1,250 we said for taxes, and I think it was $300 for insurance. That's all they account in the DSCR side, so it's $8,550. So Andrew Russell, how in God's name do you qualify for this amazing mortgage? Got to put dollar bill. So again, a 4-unit property, there's going to be 1 unit, 2 unit, 3 unit, 4 unit, and let's say each unit, the market rent was $2,500. Now again, these properties are vacant for this investor. What does that mean? When you buy them, no one's living in it. So as long as the health and safety is okay and they're habitable, meaning someone could move in tomorrow and there's nothing wrong with the property inherently, we will go off of the market rent. So if you add $2,500 times 4, it's $10,000. So a DSCR mortgage, a lot of different caveats, again, for qualification. They want to make sure your credit score probably these days around a 660-ish, could be a little bit lower, but just be very rough, 660 or more from a score perspective. Credit profile, not a big fan of mortgage rates, especially in the last 12 or 24 months. They don't want collections, judgments. They just want to see that you're paying your bills on time, ideally. There's always a one-off where you can make an exception, but ideally you're paying your bills on time, and especially on the mortgage side, that you're kind of flawless there. That's super important. On the asset side, they typically want at least 20% down, sometimes a little bit more. Closing costs are obviously outside of the $250,000. Closing costs, could get up there a little bit, but they want to see reserves. What's a reserve? So you see right here, this mortgage payment, $85.50. They want to see how many of those payments you have in the bank left. Now, typically, what does that mean? So if you have 3, if you have 6, sometimes they want 12. So 3 times that is like a little over what? 25K-ish, a little higher than that, just being a little bit rough. This is around 50. This is around, 100, something like that, right? So they want to see you have this money left over in the bank. You don't have to pledge it. You don't have to, I swear. It's just after you close, they want to see for a rainy day that you can cover this mortgage for 3 months, 6 months, 12 months. God forbid the tenant is not paying. That's a very important piece on the asset side. So again, we went over the credit, the score, the profile. This is the asset side. So now it's kind of loosened up. You could be a first-time investor. You could be a first-time buyer and get these. It has to make sense. Remember, 2 types of fraud right now. The most popular, which is horrible, saying you're going to move in and you don't, or saying you're not going to move in and you do. It's occupancy fraud. It's a huge no-no. Don't do it. But these are the type of mortgages, a no income check based on the property. Someone could say they're not moving in and do, but that's a huge no-no. So make sure you don't do that, guys. So with that said, this specific property, the 125, the 20% down, the $250,000 out of pocket, the $1 million loan, the $85.50 a month, market rent was $10,000. So as you can see, market rent is over the mortgage payment, so you qualify. So typically on DSCRs, they look for like a 1-to-1-ish ratio, right? Which we're a little bit over. The 1 would be the market rent. This would be the mortgage. So we want to make sure at least the mortgage is covered or more so by the market rent. Now, in the case that it's not, sometimes lenders are okay with 75% of the mortgage being covered. Sometimes lenders are okay now with 60% of the mortgage being covered. So the mortgage is $85.50. What's 60%? Something like 5,000-ish. What's the catch? Catch rate at 7% might go up. In the case of 0.75, you might be looking at 7.5% as an example. At a case of 0.6, maybe 7.75% as an example. There is something as an NR, right? Meaning a no ratio, meaning they don't even care about the rent. You might have to put a little bit more money down, and definitely this rate, it could go up to even 8.5, 9.25. Why would you ever want to do that? Maybe just because the rent here is so sweet that maybe after you increase it to 9.25, it still cash flows, and I'm not really sure. So maybe if you have a rate of 9.25 and this payment goes up a lot, maybe these market rents only showed $1,500, but the person was going to renovate them, and then they go up to $2,500. Maybe they go up to $3,500, which would be all the way up to $14,000 in terms of rent. So sometimes there's a little bit more that goes into it, but this is typically what you see. They always look for at least a 1-to-1. Nowadays, if the rent's a little bit lower, it's acceptable, and you could even still do a no ratio. It's a lot of stuff, guys. Trust me, I get it. Make sure you go in the description, click the link, get the Go to Vol Mortgage, the investor mortgage, our free guide there. Again, team spent so much time on it. It's actually really nice, guys. Go in the description, click the link. It's free. Make sure you get it. Now, guys, if this video made sense for you and it piqued your interest in being an investor, make sure you watch the next video why 99%, that's right, of investors don't use DSCR mortgages. I'm going to dive into why aren't they using them, why aren't they educated on them, and what you could be doing to use them to increase your real estate riches. Make sure you watch it, guys.